Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Ryan Grabinski. Ryan is an investment strategist and managing director with the firm, and we're going to talk all things markets today. But first, Ryan, how are you doing?
I'm doing well. It's great to be back.
Great to have you back. I feel like we get you during these earnings seasons, which is really fortuitous because you do a lot of work on the earnings and allocation side of things. So before we get into a few other things, let's just get your update on where we're at about halfway through an earnings season.
Yeah, absolutely. So we're a little more than halfway through. Obviously, growth has been coming in better than expected. That's no surprise. It almost always does every quarter. I've actually started looking at the 6 months back projections, and that's where we're a little weak. So right now the estimate is at about 8%. As of January 1st, it sat at about 4.9%, but if you look back to October 1st, it was north of 11%. This suggests to us that obviously the bar had been lowered heading into the earnings season, and companies are beating those lowered estimates. One of the things I noticed from a sector standpoint, though, is if you look at the sector growth rates, technology, communications, and discretionary are the only three sectors that are actually exceeding their growth rates from October 1st. So what does that tell you? That tells you that the market continues and the fundamentals continue to point towards having a growth orientation from a sector standpoint.
Yeah, and obviously those stocks have been the ones that have been leadership for quite a while. You know, the breadth story that we saw at the end of last year, like everything working, small caps, value, growth, has faltered a little bit in January. And I do wonder if part of that is because the Fed has been a little less market friendly than folks hoped for or expected at the beginning of the year. They've taken maybe one or two rate cuts off the table, or at least been a little more hawkish than expected. Could you kind of break down what you're seeing from the Fed and how you think about that from a lens of investing in stocks?
Yeah, I would say, you know, the market has definitely pulled back its expectations for rate hikes, but I don't think that needs to be necessarily viewed as a negative. In fact, the longer the Fed is on hold with regards to the Fed funds rates, the stronger equity market performance is. So one of the things I did was I looked at the previous periods where the Fed was on hold. And for any of the periods where they were on hold for more than 100 days, on average, the S&P is up about 13%. If they start cutting rates before that 100-day time period, the S&P on average is down. So right now we rank fourth in that list. But if the Fed does hold on March and they don't cut in March, then that'll jump to second. The longest time period, which was from June of '06 to September of '07, the S&P actually returned about 22%. So just because the Fed is not necessarily going to cut rates doesn't have to be viewed as a negative for equity markets.
Yeah, I think that's a great note for people. And obviously the odds have shifted from probably cutting in March to probably not cutting in March. And obviously throughout history, you know, when the Fed cuts, it's usually to provide support for a market or an economy where something negative has happened. So that makes a lot of sense, but I do think it's worth, you know, reminding folks of. Finally, let's spread internationally. There have been a lot of headlines about China over the past couple of weeks, the equity market performance there, all of the measures that the government is taking to kind of prop up some of the hurting corners of their economy. How do you all think about China at this point? What are your thoughts there?
Yeah, I mean, I'm going to be honest. I think, you know, China, for the most part, it comes up, you know, it feels like it comes up every 6 months as an idea of an investment idea. But I got to be honest, it feels more of a trade and never really a long-term investment. When I look at our market timing chart, we show it often for the S&P 500, and I've looked at it for the MSCI China. It actually shows that since 1993, the annualized return for Chinese equities is actually negative overall. So it's really hasn't proven to be a long-term investment. I think one of the things that we're hearing about now is the potential for stimulus. But if I'm being frank, it's been in the conversations for the last 15 years. I've looked at the periods where we've seen these spikes in mentions of Chinese stimulus and documents, and you know, the performance relative to the S&P 500 is mixed. In 3 of those periods, it outperformed. In 3 of those periods, it's underperformed. You know, I understand that there's a proclivity to allocate to emerging markets, and China China's obviously a big portion of that, but I'm not sure that it's actually paid off over the long term, and it's really warrants more consideration going forward. And you're more often than not best just staying home.
Yeah, that's pretty shocking to hear that 30-year total return stat from an economy that is obviously massive and is talked about all the time and has a huge weight in those EM indexes. So worth paying attention to, if you're kind of passively exposed to emerging markets. But this has been really good, a good walk, kind of through the things that are going on right now. And we appreciate the time, Ryan. Hope to talk to you again soon.
Absolutely, Ross. Have a good one.
You too.